Welcome, everybody, to the RELAC webinar on asset allocation. With thousands of investments to choose from, finding the right mix for your goals isn't easy. Today's session covers how the right balance of stocks, bonds, and mutual funds can help manage risk and move forward with your financial goals. Here to walk us through it is Scott Geberts, Program Manager and Senior Wealth Advisor at Southland Credit Union. Scott has spent nearly 2 decades in financial services, helping members grow and protect their wealth through comprehensive planning and investment management. One quick note before we start: if you opted in to hear from Southland Credit Union when you registered, they'll follow up over email after today's session. And looking ahead, RELAC's fall general membership meeting will also be a webinar on September 23rd. The theme is hearing from the directors what matters to you now. Watch for details in the forthcoming July-August newsletter and keep an eye on your email. With that, Scott, the floor is yours.
Perfect. Thanks, John. Hi, everyone. Once again, my name is Scott Geberts. I'm the Senior Wealth Advisor at Southland Investment Services. Today, like you mentioned, we're going to talk about asset allocation. If you have any questions throughout the presentation, please put them in the Q&A section, and we'll leave some time at the end to answer them for you. But let's get started. In regards to asset allocation, we're going to talk about how it's designed to help balance risk and reward to help you as you pursue your goals when it comes to investing. These are the topics that we're going to be focused on today. By the time we're through, you will understand how asset allocation works and why it can be a very important tool within your investment strategy. You're going to have more insights into the different types of investments used as strategic tools for asset allocation. You're going to know how to calculate your own asset allocation, and then you're going to have the information necessary to help set up your own asset allocation and investment strategies. And/or if you need help, you can always come to us. But first, what we're going to do is one thing. But first, what we're going to do is we're going to review what asset allocation actually means. Asset allocation is dividing an investment portfolio strategically between different types of asset classes, such as stocks, bonds, cash, or cash equivalents. The mix of the assets should help determine by your investment goals, by your time horizon, and by the level of risk that you're willing to accept. Most simply, the easiest way of looking at asset allocation is it's the way to keep us from putting all of our eggs in one basket, so we can do a better job of balancing potential risks while pursuing potential returns. It is considered one of the most important decisions that we make as investors. There's this study that came out initially in 1986, and then they redid it in 1991, which is called the Determinants of Portfolio Performance. And the study, what it did is it looked at data from 82 large pension plans and determined that the key driver in how those returns of those portfolios did was due to their asset allocation. So over 90% of the return that we get within our portfolios is actually due to how we select the assets that we put in our investments. Of course, there's not a one-size-fits-all when it comes to investment portfolios, but we like to do it based on our particular goals, timelines, resources, and our own personal circumstances. And obviously, those vary by person to person. And while there's no guarantee that it will help you increase your returns or reduce risk, there are strategies that help you potentially do both. So this kind of goes over the major asset classes that there are: stocks, bonds, money markets, instruments. We'll go in more detail about those as well. Oops, let me go back previously, sorry. There are a lot of different investment options out there. Stocks and stock mutual funds, corporate and municipal bonds, bond mutual funds, life cycle funds, exchange traded funds, money market funds, U.S. Treasuries. When you're looking inside your 401ks, you'll see a bunch of different options that you have available to you. These options boil down, though, to three basic categories: stocks, bonds, and money market or cash equivalent. They come with different levels of risk, different levels of return, and they obviously react differently to different circumstances and timeframes. And so it's good to understand those in greater detail as you make the decisions. I think it skipped ahead a little bit, but okay. We're going to talk about the different asset categories. When we talk about stocks represents ownership in a company. So you buy a share, for example, of Apple, you're a part owner of Apple, the corporation. If the company does well and the value of the company goes up, so does the stock. If it does poorly, it can go down in value. When you talk about bonds are basically an IOU that a borrower, which could be the U.S. government, could be the state of California, it could be a corporation. What they do is they promise to pay you interest, and then at the end of the term, give you back your principal. So bond, you're a lender, you're not an owner. And then cash, or like cash securities, or are short-term investments such as treasury bills. A lot of times they'll do like CDs and whatnot that can be readily converted back into cash, which is why they're called cash equivalents. We're going to look a little bit closer at each type. And when we look at this chart, I know it goes only to 2021. If it went higher, you would see actually larger growth within them. But what it does is it shows the performance of each category: stocks, government bonds, treasury bills, and then comparing it to inflation, so the cost of things getting more expensive over time. In this example, the hypothetical starting value for each one was $1 back in 1926. Obviously, they go a lot further back. Let me see. In this example, I believe treasuries are done by the orange line, and so $1 treasury in 1926 is now worth $22 in 2021 in this example. Inflation at that same time went from $1 to $16. And so what you're seeing is an average return over that time of about 3.4% for treasuries, while inflation was at 2.9. So it means that you grew your money, but not very much compared to how much more expensive things got. And so that's why things that are a little bit more safe, a little bit more conservative, tend to return a little bit less over the long term. If you look at government bonds, they grew from $1 to $177, which is a compounding of 5.6% during that time. So a little bit better over that time frame. So higher than inflation, higher than treasuries. And then if you look at stocks, large stocks and small stocks, they grew the largest from 1 to 14 and 1 to 56,000, which is obviously a 10% return for large stocks and 12% for small stocks. So as you can tell, the longer that you have, the higher performing assets tend to be the more aggressive and or the more risky within it. The shorter term time frame you have, the safer investments tend to hold up better. And so this is kind of shows you that over a long period of time. Let me see. Investors who aren't sure how they want to invest in different asset classes, if they don't know how to pick individual stocks, tend to look for ways to invest in stocks, bonds, and cash equivalents in a way where it takes the picking out of their hands. One way that people tend to do it is through mutual funds. Mutual funds make it easier for you to diversify your money. The way that they work is they're an investment company that pulls together money from you and other investors, and they each have a objective to the fund. So they could be only investing in large U.S. companies or bonds or cash equivalents. There's over, I believe, 30 to 40,000 different mutual funds out there. And so when you buy shares of that fund, you're the owner of that fund and the underlying investments within it. Some of them are specific to industries. So like if you, for example, want to invest only in tech companies, or if you want to invest in, say, like utility companies. So they have specific to that. They have diversified ones, conservative all the way to aggressive. Some are designed to create dividends. Some are designed to grow dramatically and just are about growth focus. But they are a vehicle that people use. And a lot of times when you're looking inside of your employer plans, your 401ks, any IRA accounts that you have, they are one of the vehicles that people tend to use. They're overseen by a professional fund manager, so you're not the one making the decision. They have a team, they buy, they do the selling for you. And so they are a way in which you can invest and diversify your money. In a minute, we're going to review asset allocations designed for specific goals, but before then, it would be helpful to take a few minutes to help calculate where your assets are now. There's going to be a worksheet that we'll send to you that you'll be able to look at your current investments, whether it's your 401k, any outside investment IRAs, or just brokerage accounts that you have, to kind of help determine what your current asset allocation is. And so once you get that, I believe I'll have our back office send it out to all the participants tomorrow. Please take a look at your investments, go through it. It'll kind of give you a gauge of where you stand. A lot of times on the statement itself, it'll tell you the mix inside of it. It'll show you how much are in stocks, how much are in bonds, how much are in cash, and the breakdown within each category. So whatever financial goals you have, whether it's retirement planning, building an emergency, saving for a new home, putting your kids through college, the best time to start building your strategy is obviously now. Different goals may require different types of investments, different allocations, different time frames to achieve them. And if you haven't already set those up, I would highly recommend writing down your goals with your money, what you're trying to do, and then determine the time frame that you have that you're looking to achieve them. If you're looking, the kid is going to go to college in 10 years, you have 10 years to start saving. If you're going to retire in 15 years, you have 15 years to save for retirement. The goal is just to kind of know what you're saving for and how to position your money for it. The first goal people typically save for, and I always highly recommend doing it, is to build an emergency fund. The average American lives paycheck by paycheck. So having enough in case something happens, you get sick, you lose your job, unforeseen circumstances, and expense that you didn't expect to happen. It's always good to have a emergency fund set up for yourself. Normally, I would say at the low end, 3 months worth of what you spend. So whatever your monthly expenses are, times them by 3 months. If you want to be a little bit more conservative, it would be 6 months. And then if you want to be very conservative, it'd be 12 months worth of what you spend in some type of vehicle that you have access to, just in case. Normally, though, after we build an emergency fund, for me personally, as I've done this for over 20 years, helping people kind of reach their goals, the most important one next would be retirement planning. You don't want to work forever. And so it's one of those where the earlier you start, the more you save, the more you set up correctly to grow, the more likely you are to reach your goals and be able to retire when you want to. And so once you establish your goals, whether they be to get a new car, a new home, college, retirement planning, maybe a vacation home or an emergency fund, it will help you to determine how to allocate your money. Each goal must be considered for creating the appropriate asset mix. Not every investment should be in the same investment. So you also need to take your risk tolerance into account. Not everybody can sleep at night knowing that their accounts fluctuate up and down. So you want to set targets and then rebalance your portfolio every so often, just to make sure it's aligned with what you're trying to do. That is a large part of what myself and Jag, our other advisor, who I believe is going to join me for the Q&A section at the end, do, is we help people understand how their money's positioned, make sure that it helps them reach their goals. If it's not set up correctly, we kind of walk you through how to shift it to make it help you reach your goals. We constantly meet with you to make sure you're on track to reaching your goals, and then we make sure it aligns with your risk tolerance. Not everybody's willing to accept a lot of risk, but there's trade-offs, whether you do or don't take the risk to get to where you need to go. Let's see. One of the reasons why we kind of tend to focus on retirement planning and why we're talking about asset allocation is back in the day, people typically had pensions, people had Social Security, they retired at 60 years old, they lived to early 70s. Now we're working longer, living longer. People don't typically have pensions anymore. Social Security is becoming a little bit more iffy in regards to how it's funded. It's not set up currently to last forever. And so the goal is to help protect ourselves. We now have options like 401k plans, 403bs, 457, IRAs that we can save for ourselves to protect ourselves, but we're not taught how to do that. So the goal is to learn the basics so that we can better take care of ourselves and bring in the experts when we need help with it. And then obviously when you're looking at college, the cost of college keeps going up every year, typically between 4% and 6% per year. I currently have a daughter that's at Michigan State, and it's $70,000, $80,000 a year to go there. So the goal when we're saving is knowing where we need to put our money, how much, and then how much we need it to grow. So after you've established your goals, the next step in determining your personal tolerance for investment risk and how you make it work within your timeline is the next step. Your risk tolerance will depend a lot on the time frame that you have. If you have 20 years before you need the money, you can take more risk because you have more time to recover if the markets don't do well. Even though obviously 20 years, things can go down, the likelihood of it going down over an extended period of time is less. So if you have a time frame of like 5 to 10 years for needing the money, potentially you have to be a little bit more accepting to take a little less risk because you can't afford to have the market be down as much if something was to happen. And as you get closer to needing the money, a lot of times people tend to scale back their risk to make sure that it's there for them when they need it. So we always tend to time the risk tolerance to the time frame that you need the money, and then we invest in that way, the appropriate way according to that. We're going to look at kind of a few common goals and timeframes that you can think about when you're allocating your assets. So like I mentioned before, emergency funds prepare for the unexpected, job loss, illness, accidents, emergencies. Typically need about 3 to 6 months worth of living expenses. Major purchases, new homes, new cars. If it's within 2 to 5 years, you want to consider the different investments that might be suitable for that. If you have more than 10 years, if it's college savings, retirement savings, it allows you more options to take a little bit more risk to try and grow your money. And then wealth preservation, to ensure retirement plans stay on track. And obviously, you're starting early and trying to go for a long period of time. You need the money to last for 20, 30, 40 years. And so making sure that you never run out of money once you're in that stage. So setting aside money for emergency funds is an example of hoping for the best, but obviously planning for the worst. Experts recommend having emergency funds, like we mentioned, 3 to 6 months, just in case. They cover any necessary expenses, food, water, electricity, heat, rent, mortgage, insurance, healthcare costs, any debts that you have. You can go without discretionary spending, so things that are like eating out, stuff like that. So this is more to cover just true expenses that we have. Let's see. The main issue when it comes to emergency funds is you want it to be accessible to you, so money that you can access right away. So typically you don't want it in investment vehicles that are locked away that you can't touch. So most of the time when people are looking at emergency funds, they're thinking of, say, like a high yield savings, short-term CDs, maybe a money market fund, U.S. Treasury, something short-term that they could get access to very quickly. The main issue when you're looking at emergency funds and what you put it into, it's there, it's available for you, but typically they don't earn that much. So a lot of times you'll see with people, and we'll see it all the time here, is people have a dramatically higher amount of money sitting in a savings, a CD, not earning much, more than what they need for emergency funds. And that money isn't working well for them. And so what our job is to help you reposition some of it to grow for different other goals and make sure that the money that you truly need is in the right vehicles for you. If you're planning on a major purchase, I get lots of clients that are looking to buy a home potentially in the next 2 to 5 years. You're looking at where do you put your money? And obviously this thing to the right gives a kind of hypothetical example, but you can't take too much risk, but you can take a little bit to try and grow your money, because we need your money to grow. Maybe it's going to be used for the down payment. Maybe it's going to be used for college or a new car or whatever it may be. If it sits in a savings account, sits in a CD, it may not grow enough. And so there are different ways you can allocate your money to help it grow better. Things that can be a little bit safer like bonds, or things that are inflation hedges and cash, and then stocks designed to actually grow it long term in case the market continues to go up. But when you have long-term goals, retirement planning, college expenses more than 10 years, it affords you the opportunity to go more aggressive with your investments. And so this just shows an example of a more aggressive portfolio. Not to say that this would fit you or any particular person's needs, just an example where if someone has a long-term time frame, stocks tend to be the best performing asset class. So it would make sense to have more in there if someone's willing to accept the level of fluctuation and risk that you're taking for it. So anything related to 401ks, IRAs, make a dramatic difference, your asset allocation. I have seen over the 20 years quite a few people that were risk adverse, and so they sat inside their 401ks in things that are like cash equivalents, and they were earning 2 to 3% within their portfolio versus the stock market averages around 10. And over a 20-30 year period, that can be a dramatic amount of money, sometimes in the millions, that they leave on the table. So making sure that you're allocated correctly based on your time frame, based on your goals, is very important. When we're talking about kind of preserving wealth, or when you're in that distribution phase, so when you're in retirement, you're taking money out, a lot of times people want to ensure that they don't run out of money. So when they're pulling money out, they want to be allocated in a way where their money's still growing, but if we're wrong, if the markets don't do well, they're set up in a way to not wind down their money over time. There's a thing called sequence of return risk that is, you can't control what the stock market does over the long term. You can't control what happens in the next couple of years. People, for example, I'll use 2008 as an example. In 2008, 2007, market was roaring, everything was doing great. We had this big decade of just everything going up. You saw some cracks starting to happen. In 2008, we had the housing collapse and the financial collapse, where the stock market went down 40 to 50%. Anybody that was retiring in 2007, that was still in the market, was more aggressive, got a very big wake-up call. In 2008, they're down potentially more than they could afford. They need to take money out to live off of it. Makes it very hard to recover. So a lot of times when you're in a phase where you might need the money, people tend to scale back some to make sure that in case you get a 2008, in case we have something that goes on, your money's still there available for you. We're going to talk a little bit about risk. Risk is subjective. It depends on kind of the goals. There are risks to staying in cash. There's risk to being very conservative. One of the risks to being conservative is inflation. Things get more expensive every year. Right now, we're seeing it when it comes to gas, when it comes to food, when it comes to travel. Cost of everything goes up over time. And so if you're sitting in instruments that aren't keeping pace with inflation, you're technically losing money. You're losing the ability to buy things that you want. On the opposite end of the spectrum, when you're in the stock market, you have market-related risks. So you have the risk that the market can go up and down over time and potentially lose value. And so one of the things that people do is they kind of manage it based on the time frame, like we keep talking about. Over a 30-year time frame, the stock market averages roughly a little over 10% a year. When you do a diversified portfolio, like a 60-30-10% cash portfolio, over that same 30-year period, it averages around 8.37%, but a little bit less risk. The risk for 100% stock portfolio was standard deviation was 17.19. For the 60-30-10 mix, it was 10.8. Obviously, diversifying doesn't ensure that you won't lose money, but it gives you a better opportunity to help protect. So when you are looking at your assets to figure out how they're allocated, it's not a one-time decision. You need to recognize you may need to make adjustments based on what's going on in your life. Maybe your job has changed, you got married or divorced, or you had a kid. Those are just a few examples of when it could be a good time to look at your financial goals, to reevaluate your allocation just to make sure you're set up correctly. I recommend that you review your asset allocation at least once a year. Even if there hasn't been any big changes in your life, you might discover that the market performance has shifted your allocation and you may need to make an adjustment to it. But anytime you have a big life event, it's always a good time to take a look at it. It can seem a little overwhelming at times if you aren't taught how to do this. Most people didn't go to school for what we do. So if you feel overwhelmed, confused, you're not alone. Part of the reason why I have a job. There's a lot to digest, a lot to understand when it comes to investments. We did kind of a more simplistic look at it. We didn't go into each asset category. We just did a kind of broader range of it. But there's a lot more that goes into it. So if you ever need help, if you ever want to sit down with someone just to review your investments, make sure you're set up correctly, we offer a complimentary financial reviews for our members and then also non-members as well. So feel free to take advantage of it. I'm going to put our information at some point towards the end where you can see it if you want to reach out to us directly. There's also a lot of kind of helpful resources that you can use in addition to, say, like a financial consultant like us. I will share some with you after the fact. I'm going to open up to questions at some point, but I'll share some additional information for how we do things and what to look at. I have book recommendations if you want to learn. A lot of what we do is education. So this, for example, is an education webinar just to give you some more insights into it to help you empower yourself when you're making your decisions. But I always like to kind of provide information so that you can make the most informed decision. Your goal is not to become the expert. Your goal is just to gather information. And then if you need help, get help from someone like us for it. Let's see. But I know we covered a lot today in a short window of time. If you have any questions, feel free to put them in the Q&A section. I'm going to share some additional information for you right now, which I think will be very helpful. It shows the power of asset allocation and how it could impact your retirement account. But for the time being, while I pull that up, please put any Q&A questions in that section, and I will help answer them for you. Let me pull one thing up for us. So we have tools, and this is not obviously the tool that we use, but I use this as a very simplistic way to show people the power of compounding over time and how our asset allocation decisions will impact it. Say, for example, someone is saving for retirement. They're new. They haven't saved any money, and they want to put $5,000 a year away for the next 30 years. If, for example, they sat in some cash equivalents, they're sitting in a CD earning 3% over that time frame. They keep rolling over into new CDs. That they'd say 5,000 a year for that for 30 years, it would grow to 257,000. Seems like a lot, but 30 years is a long time. If they were in something that was bond related, the average is around 5%. It goes from 257 to 370. If they're closer to the aggressiveness of the stock market, it goes from that all the way to close to $1 million. So you can see the difference of how we pick our investments and how aggressive or conservative we set it up can be a dramatic difference over a long period of time. Someone's already has 100,000 saved and they're saving like say 5,000 a year for 20 years and they earn 10%, they're at $1 million. Same thing if they earn 3%, they're at 300,000. So the idea behind it is that will help determine how much your money grows. So the time frame that you have, how much you're saving, and what the investment earns will dictate how much you actually save. And it can be a dramatic difference over a long period of time. Let me see if there are some questions. One of the questions has to do with wanting to give funds to grandchildren. The money is mostly in bonds and some in mutual funds. And in regards to taxes, part of it depends on, so that's partially a tax question. I always recommend talking to your tax consultant, but a part of it depends on how the account is titled. Is it in the name of a trust? Is it in a retirement account? Is it in a custodial account for them? Is it in a 529 for them? It just depends on the vehicle. So if you want to explore that further, feel free to reach out. I'm going to put our contact information right here. That would allow you, we could kind of talk more in detail about it, but a lot of times when it comes to that, it has to do with the vehicle, what the type of account it's in, what investment vehicle it's in, how long you've held it for, and then how you want to gift it to them and when. So we can always walk you through that process as well. I'll go back to, but a lot, and this is obviously, there may not be that many questions. You may be on your lunch break enjoying food. So I'll just talk a little bit more to give you some more insights. But most of what we do, what Jag and myself do all day long, is financial planning for our members. We'll sit down, we'll send you a list of documents to gather, we'll look at your finances, your income, your expenses, what assets you have. We'll help you determine your goals for you. And then what we'll do is we'll put together a financial plan that will show you what it will take to get there. And then what we do after that is kind of show you how the investments will need to be set up to get to those goals. So whether we look after them, because we manage money as well, or it's in your 401k, we can help you to determine what investments make the most sense to help you reach your goals. If you don't have a financial plan, I highly recommend taking advantage of it. Most people don't, and it makes every decision more, I would say, better. It makes it easier to last when you're looking at the market. And I'll show you one other thing that people tend to sometimes. The S&P 500 is just the U.S. is like an example of the 500 largest companies in the U.S. stock market. There's a bunch of different indexes that track stocks. This is just one of them. That's kind of the most well-known one. But when you look at it long-term, as you can tell, it does very well. Since the last 5 years, it's up over 72% during that time. Knowing how to position your money is half the battle. Once you have the goals set up in place, you know what vehicle to put money into, then the goal is to figure out what investment to put it into. And that's pretty much all we do all day long for you, is figure out how to do that. But if there aren't any, let me see if there are any questions. Let me see. And John, I wanted to see if you had any questions or anything else you want me to cover. I'll leave it open for a few more minutes just in case you guys have any questions. But the short of it is there will be an email, follow-up email from us with the worksheet that will help you to understand your own personal asset allocation. You'll also get our contact information if you would like to set up a complimentary financial review. It could be done via Zoom. It could be done in person at one of our branches. It could be done almost anywhere, to be honest with you. And then we can help you to determine if you want to learn more about investments. I can give you resources related to that. We have other webinars that are coming up as well that are always posted to our website. So if you ever want to know what we have available, I will go to our, oops. I believe it's, if you go to our website and learn, it'll be under seminars and worksheets. So it'll cover different ones that we have coming up. So like, for example, anybody that wants, like, and I think these are some of the most important ones to think about. The main things that you're looking at when you're talking about how to protect yourself is, if everything goes well, how am I saving for retirement? If I have an emergency, do I have an emergency fund? If something, God forbid, something happens to me, how do I protect my family? That's insurance. That's one topic we're doing in September. And then how do I protect my assets for my loved ones? Living trust and estate planning, one of the most important ones that we do. And then talking about like financial plans, like how to set one up correctly. We do that as well in October. And then we're talking about annuities, other types of specific investments. But if you have any questions about any of that, you want to take a deeper dive, feel free to reach out anytime. I'm more than happy to help you.
Wonderful. Well, thank you so much, Scott. That was really great. Very informative. I'm sure folks might follow up with more questions. But if that's all that we have, unless anybody has any other questions they want to throw into the Q&A, I think that will be it for today's RELAC webinar. Thank you so much again, Scott, and to everyone who attended. If you did opt in for follow-up emails, you should be receiving those shortly. Otherwise, you can certainly feel free to reach out to Scott and the folks at Southland Credit Union. And just once again, we have our general membership meeting webinar coming up in September. So keep an eye out in the forthcoming newsletter for that, as well as your email. So thank you again, Scott, for being here. And thank you all at home for attending.
Thanks, Sean. Appreciate it.
All right. Bye, everybody.